Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission, if you're new here, is to equip people to invest wisely in both property and people so that together we can build our wealth while improving housing. I'm James, and this is my wife, Jessie.
I'm here.
Hey!
Sporting my swag today.
Nice! So am I. I got my hat on.
Matchy.
Looks good. I like it.
I should have worn my hat instead.
Oh, no, then we'd be too matchy.
Oh, yeah. We don't want that.
Yeah, then people will be like, what, are you guys married or something? Yeah. So, as I said in the intro, part of our mission here is to equip people to invest wisely, and specifically to invest wisely as passive investors.
Yeah.
Now, the thing about being a passive investor is that it's not 100% passive.
Mm-hmm.
You have to do some work, especially up front.
Yeah.
And namely, you have to do the work to decide, do I want to invest in this thing or not?
Mm-hmm.
So today, I want to talk more about that. I created a 196 question vault, which is a lot of questions,
Yep.
that goes through the 8 different phases of investing, of identifying a deal. And the name of the PDF is called Good Deals Only, because the idea is you invest in only good deals. And so we've already talked about how do you evaluate the sponsor, and we've talked about how you evaluate the property manager that the sponsor has chosen.
Right.
Today, I want to focus on how you evaluate the property. Okay, so what I've done is I've printed off the 2 pages from that PDF. I didn't actually count how many questions there are total from that section, but I think we can do the quick math.
About 30-ish.
About 30-ish?
Yeah.
Cool. And so I've given it to you. You've obviously reviewed it. And what I'd love to do is have you read over it and say, like, hey, what are these questions? Are there any that are don't make sense, or you want to know more about it, that you're like, oh, that's a really good one, everyone absolutely should do it? Now, one of the things I've done, and for those of you watching the video, you'll be able to see it, I've actually highlighted in blue the questions that I personally think are particularly important. I wouldn't skip those. And so with that, I'm kind of going to hand it over to you and let you talk about the different questions and have you shoot them back to me, and I'll add more flesh to them as we go along.
Awesome. And just to put a little bit more context in this, or to like put myself
Okay.
in the flow of like where I would use this. I'm pretending I'm an investor,
Yeah.
and I don't really know much because if I like,
Well,
I
someone
want to
like
invest
me,
passively.
a sponsor, we've already talked.
Okay,
And you've got,
yeah,
hey,
yeah.
I've got somebody to place. And I go, sweet. And I come to you and say, I found the deal of a lifetime.
So you've given
it's
me
amazing. Check this out.
some sort of information about a property,
Yep.
and now I'm kind of following up and being like, okay, but what about this? What about
Yep.
that? Okay,
Yep. Mm-hmm.
that makes sense. So there's a lot of these are kind of like details about the property, which I
Right,
feel
'cause that's the
like
section.
if you're a good sponsor, and we've kind of chatted about this before, you will have given me a lot of this information
100%.
in some sort of form or PDF or over the phone or something. So a lot of it, I think, is pretty self-explanatory. What's the number of units? How occupied is it? What's the age of the property? What's the class of the property? Which
you know what
define
that-
class, I guess.
Yeah. So
Because I think it's like what it's used for, but
no.
maybe not.
No. So there's typically there's 3, and there could be up to like 5 classifications. So there's class A, B, and C. And then depending on who you are, there's a D and an F.
so is that quality of the property?
Yeah, essentially. So A is brand new build, right? So that's one of the things
Mm-hmm.
that we passively invested in, was a ground up from the bottom
Yeah.
thing, and they turned it into A class property.
Mm-hmm.
And then you have B, which is still pretty good. Those are usually in like the 10 to maybe 20, 25 years old. Pretty good
Okay.
shape. They look like they're new, but they're just not that extra special level.
Okay.
C class is typically the kind that we are looking for, where there's some deferred maintenance, there's some things that need to happen. Maybe the tenants aren't all the professors and engineers and those kind of people. They're more just like regular folks, and that's usually what the classes stop. We have bought a D or a couple D class properties. Those are typically ones where there's some sort of
There's a
problems.
problem,
There's
yeah.
there's drug issues, there's homelessness issues. There might be some massive problem with the property itself and that kind of stuff. And then I would classify an F is like, hey, we're going to tear this thing down and start over. When we were camping or driving back, we actually drove by one of the properties that I looked at, and
Right.
it's a condemned building. You cannot live inside of it.
Yeah.
It's all boarded up. There's I would put
There's
that in the
problems.
F class. of property.
Yeah.
60 units, so really intriguing. They want way too much money for. Again, a condemned, cannot live in it building.
Yeah.
There's mold everywhere. It's a problem. But that's kind of the idea. And so what you want to know as an investor is, hey, what are we getting into here? And there's different implications behind the class. So an A-class property, typically you're not going to have a huge amount of cash flow, but it will appreciate a lot over time just because the percentage, just because of how it works. There's often a lot less maintenance. The tenants, you tend to not have as many problems with them because they can all pay their rent, that kind of stuff. And with C-class, and especially with D, that is more like you're going to get a higher cash flow, but you're going to have more issues. It's going to be more involvement. There's going to be more maintenance, that kind of stuff. And often if someone says, hey, we're doing a value-added deal, we're taking it from a C class to a B class. It's typically what that is. It's very rare you go B to A, like you just can't, because A is new and you can't fake that. You could do like a B minus to a B plus,
or an F, which is demolish and then rebuild.
So you can go F to A.
Yeah.
Right, but those are huge lifts, but they definitely happen, and the returns can be ginormous if you do it. But that's what I mean by the class of property, and it's important to just not even to note what's the community like. You know, like I was looking at this place in Dayton, Ohio, and they had a property that was a C class, and they were like, we're going to do a ton of renovations, we're going to make it awesome, and we're going to bring it up to like the equivalent of an A, a B plus. I was like, cool, but you start looking around the neighborhood, and you're like, this is kind of a B minus neighborhood.
Interesting.
Like, will this work?
Yeah.
And so those are kind of things that you want to think about when they tell you, here's the class, and more importantly, here's what we're buying at, and here's where we want it to end at. So like we've got a flip going on, right? And that's... it was abandoned. There's an old man who lived in it, and so that was, I'd put that in like it's C at best. You know, you're gonna get someone would live there, but it's pretty low end, and we are gonna redo everything, and we're gonna make that. It's not gonna be brand new, but it's gonna be BP plus. When it's all done.
And the neighborhood supports that level of
actually we know it'll work because there was a property right next door where they did exactly that.
Okay.
And so the model's already been
good
proven.
test case. Yeah.
Cool.
Okay, so the follow-up questions definitely support that. Does what's the neighborhood like? Does it support more affluent or lower? Does it align with the surrounding area?
Yeah, because you want to match it, right? You don't.
Does it
I mean, I get having aspirations like we're going to make this place better. Yeah, that's great, but in general, you want to match where the neighborhood's at.
Sure. All right. Another question on here I think is interesting is why is the owner selling?
Yeah.
And it's interesting to me because, the sponsor could just be looking for a deal, but there's motivation and nuance in how it's financed or how quickly it's going to close because of what the seller needs or doesn't need or wants. So that's kind of an interesting question, and it implies a lot of things.
Yeah, and as a sponsor, I try to figure that out because it just helps with the narrative. Here's the story. Here's what's going on.
Yeah.
And like, for example, that same house that we're talking about, the guy had dementia, and they were thinking about moving him into hospice. Like, that's why they're selling. Yeah. Right? The house is beat up and worn down, but it has to do with more of a person issue as opposed to a property issue. And those are ones that I tend to gravitate. I mean, I gravitate towards both, but it's usually there's something going on in the seller's life. Yeah. They just need to get rid of it. Yeah. And it implies a different level of creativity and things like that.
Yeah, I think of another seller that you were telling me about is this, there was a need to move, for a new job or just a lifestyle change or whatever it was. And so it was like they just wanted to be done and close fast so that they could move, and it was like, okay, that's different motivation than other reasons. So okay, so this one I'm not sure that I understand it. What's the physical occupancy for the trailing 3 month T3 and T12?
Yes. So T3 and T12 has to do with, it's a bookkeeping type of thing. So T3 equals the last 3 months. Okay. T12 equals the last 12 months, and it's like tab 3 or table 3. It's an accounting term. I've looked it up at one point.
Pretty much who's been living in the property.
Well, you want to know physical occupancy because there's economic vacancy rate, which goes all the way from like there's people living there, they're just not paying right now, and that technically is a vacancy. It's just not physical. Okay. That's it's economic in a way. And so you're trying to figure out, like, how full is it? How many units do need to be filled versus how many people aren't paying and we need to go chase after them.
Okay.
Because those are two different skill sets, and one of them is actually really easy to fix. The other one can be a lot harder in Oregon, and that would be they're not paying is the harder one in Oregon. And then, the T3 and T12 just really help. Like, ultimately, you want to ask for the entire T12, and then you can pay attention to the last 3 months, because from an expense standpoint, a lot of things are cyclical, like electricity is a prime example of that, and you can see where that trend is going. When it comes to rent, what you really care about are those last 3 months, not necessarily the last 12, because they may have increased the rents, in which case a yearly average doesn't work anymore. What you really want is the last 3 months average.
That makes sense. It's like, where are you at currently? And where can we go from here?
And you also want to know where you were at, so we can kind of get an idea for the trend.
Yeah. The next kind of several talk about what needs to happen to the property, essentially. So it's almost like there's probably 7 or 8 in a row that are like, where is the property currently at as far as like how many units have been renovated, what was done in each of them, what's the list of improvements that have been made, and then what's the timeline of when things were touched, I guess, like has electric been touched, has plumbing been touched, has the roof been replaced, the big systems.
And it's really trying to flush out what class is this.
Okay, so giving like measurables for which class.
And it has big implications for the construction budget.
Right.
Because if they come in and be like, hey, you know what, it's a class B and they haven't done any repairs in the last 2 years, and we think the renovation budget for this 40-unit apartment building is $10,000, go, well, so, or if they even go, we think the renovation budget for this thing is $400,000, you go, only $10,000 per unit, really? Given all these other things that like that may not line up, because for you and me, like $400,000, you're like, oh my gosh, that's so much money. Like, is it though? And because I know some people, like, again, this single family home, I'm going to keep bringing it up. We're spending $100,000 on essentially one 3-bed, unit. 1-bath unit. Yeah. And so that just helps you get an idea. But if they're like, no, they've done this full renovation for it, everything's full, they've taken care of all the big systems in the last couple of years, so our renovation budget genuinely is like $50,000, you go, all right, that makes sense. That explains the story. So you're just trying to line up the story with the numbers.
And as a passive investor, I mean, my hope is like, yes, I would want to know that these questions are being asked, but my hope is that you're using your expertise to be like, okay, I've looked at this property, I've taken stock of all that needs to be done, I've done the math for you, and here's the goal. Like, here's what we're going to spend.
You do hope that, but it's a trust but verify situation. Okay. And so you're just making sure what they say
makes sense.
Lines up. Yep. And you're trying to get a sense
Which
for how conservative they are
because it's like,
as well. Yeah, you think so?
Because if I haven't spent a ton of time researching like how much house projects cost, I could hear that number and be like, 10,000, I don't know, that sounds like a lot. And you might be like,
so there's another section here that is this is section 3. There's
a whole nother section,
big section
of the,
which someday we'll get to, that talks about the construction plan in particular.
Okay.
And that's where you can start to dive into those kind of numbers. Be like, tell me more about the construction company. Did you actually have bids, or are you just guessing? Like, where
are you getting your numbers from?
Yeah.
Okay, that kind of makes sense.
But
because you would want to.
But you're trying to just get an idea for, because the other part of it is, if you've got a sponsor who's relatively new, and they've like, all I've done are single family homes that were already in good shape, and then they go, and now I'm buying this 10-unit place that's a dumper. You go, ooh, that's a lot of work. Do you have that kind of experience? Have you dealt with something like this? How do you handle some of these things? And usually, like, a half-hour conversation with the sponsor, you're going to flush out some of these things. And again, like you said, ideally they'll address a lot of them as well. Again, the whole point of this is, I mean, number one, you got to trust the sponsor. If you don't invest. But you also do want to do your own due diligence of making sure you understand the deal, because you're going to put $50,000 to $100,000 to $200,000 into this deal for the next 5 to 7 years.
Significant money.
So, spend the time to really understand what it is that you're investing in and where your money's going for.
Makes sense. Okay, so this next section talks about, I'm going to jump ahead because we kind of talked about the units and what needs to happen there, but is the property poorly managed?
Yeah.
And kind of why? Was it self-managed? Was it managed by a company and they just got too big? What does the sponsor think? about how they are going to manage it
Yeah.
and what that would entail. So
Yeah.
all the management type, why is it in its current state, and how are you going to improve it?
Yeah, because there's a lot of properties out there where the properties would be fine
Yeah.
if they were
The
managed
physical
well.
building is
They're just
good.
not. And sometimes they're, like, I was looking at this one property where the owner died, and then the family took it on, and they're like, we had no experience with this.
Yeah.
We don't know what we're doing. And they're like, but the idea of paying a property manager doesn't make any sense, and so we're not going to do it. Or, this actually surprises me a lot, you get a property manager who they'll hire them, but then they'll hamstring the property manager because they'll say things like, well, we only want the best of the best tenants, ones who have their income is 5 times and their credit score is a 750 plus, and we don't want any issues. And they go, cool. And they just start sitting vacant.
Right.
And
because the pool is very small.
And that's where the property manager could do a better job of, like, all right, let me bring you along. Let me educate you. Let me show you what we're doing. Let me build some trust with you. And that just sometimes doesn't happen. Or for whatever reason, they've got some, or there was another property I was looking at up in Portland where this guy, his model was to kick everybody out and then just totally redo everything. Again, he's going for that B plus A class thing. And then he ran out of money partway through and went, oh, shoot. So now he had this vacant property that was half repaired, and, like, what do I do? Right? And that was just, he mismanaged the budget type of thing. Where you go, okay, the business plan was a good idea. He just wasn't well capitalized. And that situation was actually hard because no bank will loan on it because they're like, dude, we don't loan on those projects right now.
Yeah.
And so you would have to come to the table with all the cash, which hurts your return on investment.
So could you say in that scenario, if you were a passive investor who invested with that sponsor, perhaps you didn't do all the due diligence you should have done?
Yeah, I know in that case he wasn't using anyone else's money, but yes, if you were, that's where, and sometimes that happens, right? As a sponsor, let's say you do run out of money, now you have a choice. You either sell it and try to return as much of the investor capital as you can, or you go back to them and say, hey, I need more money.
Yeah.
We're doing a capital call. Yeah, that's risky business. No one likes that. So oftentimes investors will be like, nope, I'm just going to sell it as is, and we're going to try to get everyone's money back, and I might make nothing, and I will just try to return everyone's capital.
Interesting. All right. The next two are about income. Okay. So if rents are low, what's making them low? And I would even put a follow-up on there, like, what's the how much could you increase them? What would that look like?
Mm-hmm.
And is there a limit? And how do you know it?
Yeah, those are those are good questions. Yeah, and that's the questions you should ask.
Like, yeah, you should ask that. That's great.
Well, that's good.
And then, I mean, similarly, are the expenses high, and why might they be high?
Yeah.
And then what's the plan for reducing expenses?
It's like I was looking at this one property, and it's a 32-unit building, and there was an electrical expense of $11,000 a year.
Yeah.
And I was like, what are they spending $1,000 or $900, $800 on per month?
Yeah.
I was like, this is confusing to me. And so that's the kind of thing where, because I know in Oregon, as a general rule, the electrical bill for a multifamily is going to be in like that $100 to $200, maybe for like outside lights or for water heaters. Like it shouldn't be very high at all. And so that to me was like, oh,
yeah. Why is this
interesting?
So high?
I want to know more. Now I definitely underwrite it to that number and I go, hey, that's real. It is what it is. But that's the kind of thing. And as a passive investor, ideally the sponsor is going to point that out and go, hey, there's some low hanging fruit right here. I'm going to add 10 grand to this thing. And in a 5 cap market, that's huge. And so that's the kind of thing. Yeah. You want to, and obviously you don't necessarily know what is out of bounds.
Sure.
Pro tip. You should expect expenses to be like 40% of revenue in general. And if it's way off from that, you'll be like, just ask questions because there might be a really good reason for it. And again, like in my case, that one example, I was like, yeah, it is off and I'm going to fix it. My guess in that particular case, because I don't actually know, is they just had some deals with tenants who, or they asked them to put the electricity in their name and they never did and they never followed up. They just kind of paid it and were like, whatever, it is what it is. The pot slowly boiled. Or they had some sort of deal where maybe they're on HUD and HUD was like, hey, you have to pay for the utilities. The tenant can't do it. So like, okay, fine. Like,
interesting.
I don't know. I've seen stuff like that.
But either way, research
Ask about it.
Ask about it. Figure it out.
In a multifamily, you shouldn't see electrical as an expense, or it should not be very big. And ideally, the total expenses are in that 40% range.
Cool. And then how does the rent roll? So the money that you're bringing in or that has been brought in, how does it compare against the underwriting's gross potential rent and vacancy rates?
Yeah.
So essentially you're kind of comparing like how much is it making now as to how much it could make.
Correct. Yeah, so gross potential rent is if everything was rented at the current possible market rates, here's how much money it would make. But a property is never rented at that because someone who rented 6 months ago is no longer at the market rate, right? And so there's always some factor in there that's somewhere in like that 2 to potentially like 10%, I guess.
Okay.
I mean, if they're managing it well, it's going to be 2 to 5%.
Okay.
And so it's kind of in there. But then there's another vacancy rate piece, and in Oregon, honestly, like vacancy rates are like at 2% right now. It's kind of ridiculous. So I would love to underwrite them at like 15%. I usually find that's way too conservative and it just doesn't make any sense. It doesn't match reality. So I'm usually in like that, we'll do 5% vacancy. Yeah. And then I'll typically try to tack on another 5% for the economic piece. Somebody's not paying, stuff like that. But you want to compare, here's what it actually was versus what they're saying. And ideally, what you find is that those numbers are pretty similar and that the sponsor's not just being like, oh yeah, no, we're going to increase everything 100%. Or if they are, they're going to have a really good reason for it.
Yeah, they have to have reasons for it.
Yeah.
And then some of these follow-up questions alluded to the same thing. So what's the average rent in the last 90 days? How does that compare to the overall average rent of surrounding properties?
Again, that 90 days is important, right? Because you don't want to do necessarily the entire year. You want to be like more recent.
Because it could change.
Rents? Because it doesn't. Because the future rent isn't the average of the last year. The future rent is the last month carried forward.
Sure. And
so that's why you want to just, and that's the whole point of the T3 versus T12.
Okay. And then a couple just property questions. What's the replacement cost of the property? Is it in a flood zone?
Yeah.
Parking to unit ratios. And how does that compare?
Because that helps with desirability.
Yeah.
That's one of we have our apartment building, and there's only street parking. There's enough for everybody, but it is only street parking.
It doesn't have its own separate
desirability, and so you go, okay, that's good to know.
Yeah. Just other factors to help evaluate the property, the costs of the property.
I would recommend as a sponsor, as a passive investor, whenever you're looking at a deal, hop on to rentometer.com or go to Craigslist or Facebook Marketplace and just search in that area for that type of rentals just to get an idea for what rents are at and just be like, are these in the ballpark? And they should be in the ballpark.
Is it the kind of thing too, this sounds kind of creeperish to me maybe, but I'm also like, it might be a good idea. I was just thinking if you're local and you know where the property's at, could you drive around that neighborhood and just get a feel for the types of properties and who you see walking around?
Yeah, no, 100%. I definitely think, and you should, as a passive investor?
Yeah.
Yeah, sure.
I don't know. Just,
totally.
Yeah. If you know,
absolutely.
I mean, you might as well, because I'm very visual, I know, and so I'm like, that would help me a lot to know where the property's at and what it's next to and what does it look like in that area.
Yeah. There's a podcast that I follow. This guy, his goal is to raise $200 million, which is a lot of money.
Over his lifetime?
No, in the next year.
Oh.
Yeah. But it's for this massive project that he's doing. And he actually talks about doing investor days where he's like, dude, we're talking big sums of money here.
Yeah.
And everyone's writing $1 million or more type of check. And he goes, we fly everybody in.
Ooh.
And we do we're going to do a fancy dinner, and that's where we're going to talk about the deal. We're going to talk about the property. They're going to go through all 196 types of things. He goes, and then the next day, we're all going to get up and we're going to take a tour of the property, and we're going to look at
that's pretty cool.
At the neighborhood. And he's like, and they're all going to get to know each other, and we're going to do some networking. And I'm like, dude, that's pretty awesome. That works well for big ticket stuff. I'm not quite at that level, but I'm like, it's an intriguing idea. So no, it's not creepy at all. And for bigger stuff, that definitely happens.
Yeah, that makes sense. Okay, last few types of things. This one I thought was a little weird, but I guess I get it. Is there an office on the property? Does it need to be upgraded, and is it functional? And will the property manager be using that or living on site or be off site? Which I guess kind of makes sense. It's more of like a management question.
Yeah, you're just trying to get a feel for how's this thing going to be run. And often the office is an expense. It's not this, hey, we're going to rehab this unit and then we're going to rent it out.
Right.
So you want to know those kind of things.
Okay.
And again, it's just helping you as the passive investor get a good like visual or story behind what is this investment
How
that I'm
does this
doing?
run? Yeah.
What, and that's kind of related to like what are all the amenities? Is there a pool? Is there a gym? Is there a, I don't know, they used to have like office centers, but that's kind of like, it's not really a thing anymore.
Not really.
Thanks, internet. But yeah, so that so that's kind of related to that. Is there an office? Is there a laundry room, or are they
amenities?
units? Yeah, you're just trying to get a sense for what does this place offer.
Okay. And then there's a specific one on here about signage. Does it need to be upgraded? What does it look like? And does it need city approval?
Yeah.
I would tend to think like even more broad than that, like anything physical, as far as like there was one kind of on here of like, what's the curb appeal, I guess, or what's the traffic going by it?
Yeah.
Does that help with renting or not? Does the signage help with renting it out or not?
Yeah.
All those sorts of things.
Yep.
I think it's a good.
And those ones aren't highlighted. They're just
they're extra ones building that story.
Feel.
I think it like especially where we're at, it seems like the city approval piece is important because it is a hang up for a lot of different things, and so it's like you want to check that and be like, all right, you have this plan, like how are you going to get it through, and is it approved, and all those sorts of things. And then last is security, like what's the security like at the property? Are there cameras around or not? Is there a guard?
Yeah.
Or not? Is there a fence or not?
And those all become more important as properties get bigger.
Yeah.
For sure. Yeah, so there you go.
There you go.
That gives you kind of an overall picture of the property. And again, this is one of 8 pieces. And I just think, again, they're good things to help you get a full picture of this investment that you're going to put $50,000 to $100,000 to $250,000 in for the next 5 to 7 years.
Yeah.
And so you just like, this is part of the non-passive piece of it, which again, not that hard. They're just asking questions, just probing, and you're not trying to necessarily get the sponsor in a gotcha moment.
Right.
You're just trying to understand more about what is this deal. And sponsors like me, I'm like, dude, we'll talk about this all day. I love it. It's super fun.
Let me tell you.
So yeah, there you go. And thank you so much for listening. If you enjoyed this podcast, we would love it if you left a review wherever it is that you listen to podcasts. And if you would like to learn more about investing with us, or actually more importantly, downloading this full 196 question vault, go to furlo.com, and there you'll see that along with a whole bunch of other really cool stuff. So with that, thanks for listening and have a great day.